Hello there! The final part of Lecture Series 20 focuses on operating lease, presentation and disclosures in the financial statements of lessor, as well as sale and leaseback, as set out in IFRS 16 Leases. IFRS 16 stipulates the lease payment receivable from an operating lease shall be recognized as an income in the profit or loss on a straight-line basis. Any direct costs incurred in negotiating the operating lease shall be added to the cost of the underlying asset. The underlying asset shall be depreciated in accordance to the relevant standard the asset falls within. A lessor shall present the underlying asset subject to operating leases in its statement of financial position according to the nature of the underlying asset. The lessor should also disclose a maturity analysis of the undiscounted lease payments receivable. IFRS 16 requires for finance lease a lessor to disclose the following: 1. Profit or loss on sale. 2. Finance income on the net investment in lease. 3. Information of changes in the carrying value of the net investment in finance leases. 4. A maturity analysis of lease payments receivable. Next, sale and leaseback. This is when an entity transfers an asset to another entity and then leases it back. In such situations, both entities shall assess if the transfer shall be accounted for as a sale by applying IFRS 15 revenue from contracts with customers to assess if a performance obligation has been satisfied. A performance obligation is satisfied when the customer obtains control of the promised good. Control is demonstrated by the ability to obtain substantially all of the remaining benefits from the promised good. If the transfer of the asset does not satisfy the performance obligation of IFRS 15, the seller lessee shall continue to recognize the transferred asset. The seller lessee shall account for the transferred proceeds as a financial liability. As such, the buyer lessor shall account for the transferred proceeds as a financial asset. In this situation, the sale and leaseback is effectively a loan arrangement with the transferred asset being used as a collateral. The transaction falls within the scope of IFRS 9 financial instruments. If the transfer satisfied the requirement of IFRS 15, the transfer is a sale, in which case the seller lessee recognizes a right of use asset at the proportion of the previous carrying amount that relates to the rights retained. Accordingly, the seller lessee shall recognize only the amount of any gain or loss that relates to the rights transferred to the buyer lessor. The buyer lessor shall recognize the transferred asset applying the applicable standards such as IAS 16, with the lease accountant applying lesser accounting requirements of IFRS 16. Finally, if the fair value of the consideration does not equal the fair value of the asset, or if payments for the lease are not at market rates, IFRS 16 stipulates any below market terms shall be accounted as a prepayment of lease payments, and any above market terms shall be accounted as additional financing provided by the buyer to the seller lessee. We have come to the end of Lecture Series 20 on IFRS 16 Leases, covering the following areas. 1. The objective of IFRS 16 and the definition adopted. 2. Identifying a lease contract. 3. Lessee accounting, including disclosures, separating components, reassessing lease liability, as well as short-term leases and low-value assets. 4. Lessor accounting, including definition of finance and operating lease, as well as the respective initial and subsequent treatment. Finally, sale and leaseback. The next bite-sized corporate reporting lecture series will look at IAS 21, the effects of changes in foreign exchange rates.